Remember our friend Sarah from podcast 26? Well, she had some time to think about things. Though the investment opportunity that she saw seemed like it could be a strong addition to her investment portfolio, she thought it might be something her parents would love. She remembered having a chat with her parents a few months back where they mentioned their interest in getting a property in Florida so they could ease into retirement over the next 10 years or so. However, they expressed that it was just a dream that could keep them motivated. You know, dreams of palm trees and beaches in the freezing cold winter. They also mentioned that they didn't know how the Joneses down the road were able to get their place in Tampa, given that both families were in about the same or similar financial situation. Being a seasoned entrepreneur, Sarah felt that this was the time to broach the subject with her parents. It was an opportunity that they should at least look at closely. She knew that navigating the real estate market could be an intimidating task. However, if you're a seasoned investor, or even if you're a first-time buyer, either domestic or cross-border or even international, she explained to her parents that the dynamic nature of property values, interest rates, and market trends requires a well thought out strategy to help make an informed real estate investment decision. In this episode of Real Estate with Nicole, we will discuss the importance of having a plan or strategy and how this real estate action plan will serve as a detailed roadmap, guiding you through the various stages of property acquisition, management, and sale. This action plan helps you set clear objectives, identify potential risks, and allocate your resources effectively. Essentially, an action plan transforms your real estate goals, dreams from simple aspirations into achievable milestones. One thing to keep in mind, as on many roads, there are barriers or cautions, and the real estate investor with a plan will need to be able to adapt or be flexible as the situation dictates. Did you grab your favorite beverage? Okay, let's get started. All right. Sarah's parents are excited about the prospect of owning a property in South Florida and to fulfill their dreams of being a snowbird in retirement. They say to Sarah, "Sounds great, dear. Just let us know where we need to sign." The weight and implications of the statement weigh on Sarah. She understands that the real estate journey for each individual or couple is unique, and she advises her parents to consult a realtor in order to guide them through the process, to understand their motivations, goals, and to ensure that they will be able to make well-informed decisions for a real estate acquisition. Sarah's parents, Max and Usha, meet with me. They are hardworking, pleasant, and a reasonable couple. After going through the initial discussions regarding working with a realtor in terms of my responsibilities, their responsibilities, we began to talk about the prospect of investing in real estate across the border. They're excited about the prospect, and Usha, since last speaking with Sarah, learned that her sister recently purchased a property in the same area Sarah identified. This simple fact was a very strong factor in the couple's new motivation to invest in the US. Usha and Max saw this as an opportunity to reconnect more frequently with family in a warm climate with a plethora of outdoor activities, while at the same time being able to maintain a healthy social life. Usha mentioned that the more she spoke about the opportunity, the more she became aware of others she knew who had already purchased a property close by. Max was on board and wanted to start investigating properties. They looked at me and said, "We're ready to go." As a realtor, my fiduciary responsibility was to ensure that before they get too excited about a particular area, home, development, we really need to understand what Usha and Max can afford. We also needed to really understand, where's the money? How do they plan to finance their purchase? And really assist them with exploring financing options for Canadians in the US market. In addition, I needed to be sure that they were clear about my roles and responsibilities, capabilities for cross-border properties, and to inform them that I would be seeking the assistance and working with a local realtor to obtain relevant data from the specific market to ensure that they are obtaining the most relevant, up-to-date information with regards to staying informed. So Max, he's happy his wife is excited about the prospect, though he has some reservations. He cannot see how he can afford to make this investment. To him, it's still a dream, even though he knows others in less stable financial situations have done so. Max says to me, I believe you've got something. How do we know what we can afford? It all seems great, and we would love to make the move if it doesn't put us in financial jeopardy. Usha and I, we've worked so hard. At this point, Max and Usha temper their enthusiasm as we discuss the differences between getting a mortgage in Canada versus getting one in the US. This process just helps to get them to understand what the differences and the similarities are so they have a better understanding and grasp of what can be expected. There are a few categories that we discussed. One was the time to process a mortgage. One of them in Canada, typically it can take between 5 to 10 days to get pre-approval or a mortgage through the system. In the US, that is more like 30 to 45 days, depending on the financial institution and the situation that you would find yourself in. In terms of the application requirements for a mortgage, all of them remain the same, being income, understanding your assets and liabilities and providing that information, describing any other real estate that you may own, describing the type of property you're planning to buy, providing 2 years proof of employment. So those are very similar for both Canada and the US. For the US, you would also need to provide proof of your country of residence. So that's a differentiating factor with regards to the application requirements for applying for a mortgage loan. In terms of documentation required, in Canada, you would require the agreement of purchase and sale, a confirmation of your down payment, and again, proof of employment and income. For the US, you would definitely require all of these pieces of information, in addition to citizenship and immigration documentation. That could be a copy of your passport. It could be your social insurance number or your social security number for US. Confirmation of income, as I indicated, would be required. For the US, if you are retired, you would need to have verification of your retirement income. If you are a self-employed, you would need to provide the appropriate documentation and tax information with regards to self-employment income. And for individual income, you would need to provide your income tax return, whether it's T4 or W2 for the US. In addition, in the US, you would also need to provide any existing mortgage and property statements. You would need to provide any account statements as well, and any insurance-related documentation. So there's some differences with regards to the documentation that's required to obtain a US mortgage versus a Canadian. Now, we discussed the down payment and the differences between the down payment. In Canada, typically we have what's called a conventional mortgage, wherein there's a minimum of 20% down, and that mortgage would not need to be insured. We also have 5% down, or the low down payment mortgage, which would require mortgage insurance. For Canadians looking to invest in the US, typically the ranges of minimum down payment come about 20% is probably typical for a home that you plan to live in all year round, or you plan to live in on a part-time basis. And if it's an investment property, you would require a minimum of at least 25% down. So those are significant differences with relation to the down payment between Canada and the US. In terms of closing costs, typically in Canada, closing costs can be minimum 2.5% of your purchase price. However, this is largely driven by land transfer tax, legal fees, and disbursement. In the US, closing costs also may vary and could be as low as 2.5% of the purchase price. In terms of mortgage interest, a significant difference between Canada and the US. In Canada, mortgage interest is not considered tax deductible. However, in the US, mortgage interest may be deductible against your income tax, depending on your particular situation. So after reviewing the differences, Max and Usha believe that they have the required document available, or at least easily accessible, so they can assess their situation. However, they do focus in on the down payment. Usha and Max state in unison, "We always thought we needed to have all cash to purchase real estate in the US." Usha asks, "How are we going to get financing from a US bank? We don't have US credit history." I indicated to Usha and Max that given the multi-billion-dollar contribution Canadians are making in the US real estate industry, there are more financial institutions that are using Canadian credit history to qualify Canadian investors. And some US-based subsidiaries of Canadian banks offer some excellent financing options for cross-border real estate investors. I further explain that investing in real estate, businesses, or other ventures, it does require a significant amount of capital. And Canadians do have several avenues to finance these investments. As I mentioned, through US or Canadian banks and financial institutions. And the choice between using a domestic or a foreign institution will truly largely depend on the type of investment, um, any currency considerations, and the financial situation of Max and Usha. Canadian banks and financial institutions offer a variety of loan products, and they're really tailored to meet the needs of investors or Canadian investors. These include traditional mortgages, home equity lines of credit, and personal loans. Canadian banks tend to have stringent lending criteria and often require a solid credit history, proof of income, and substantial down payment or collateral. However, they offer the advantage of dealing in Canadian dollars, which ultimately can simplify transactions and avoid or mitigate currency exchange risks. Some institutions may also offer benefits, such as having no prepayment penalty, meaning that if you take out a mortgage and for some reason you have the funds to pay off the mortgage, you can pay off your loan at any time without any prepayment penalty. As I mentioned previously, those banks will use your Canadian credit history. And some of these institutions also offer financing in all states. And this gives you the flexibility of choice for location of your investment. In addition, many of these banks offer payments that are low, meaning that the mortgage can be amortized over a 30-year period. And ultimately, they provide you with a great investment option if you choose to use them. On the other hand, though, US banks and financial institutions can be a viable option for you, especially when you want to invest in the US market. They offer similar financial products such as mortgages, personal loans, and business financing, and they may provide additional benefits such as lower interest rates or maybe more flexible terms. And it's really dependent on the financial and economic climate that when you finance your purchase. To finance an investment through a US bank, Canadians typically need to establish a US bank account and possibly secure an individual taxpayer identification number, an ITIN number. Additionally, cross-border lenders specialize in assisting Canadians with US investments, providing tailored services that often bridge the gap between the two banking systems. So for Usha and Max, ultimately, the decision to use a US or financial institution really depends on where you plan to invest, what your currency preferences are, and your current personal financial circumstances. Max and Usha are glad they met for the initial consultation. Usha sighs and comments, "This is more involved than I thought. However, having a plan really makes sense. It helps to get our thoughts on paper and provides us with the ability to organize and prioritize what we need to do, at least with this first step." Max chimes in and says, "Yes, I was skeptical at first. However, I can see if we have a plan and we have a roadmap of our options, we can see how we are better able to understand what we can afford and then potentially start looking. And I can't wait for that." We book another appointment to follow up regarding the documentation requirements, potential financial institutions, and continue to update and refine the real estate action plan. So with Max and Usha, and for all of us, creating a comprehensive real estate action plan involves collating appropriate information, thorough research, and strategic planning. This includes analyzing market conditions, studying neighborhood trends, and understanding the financial implications of your investments. Most importantly, it includes truly understanding your financial position and options for financing your real estate purchase. Once you know your numbers, you can refine your goals, analyze market conditions in order to optimize your decision-making process. It's important to note that this is not a one-size-fits-all approach. For example, what works for Sarah doesn't work for her parents, Max and Usha. A real estate action plan requires a tailored approach that considers your unique circumstances and your short-term and long-term goals. For instance, if you're looking to invest in rental properties, your plan should factor in projected rental income, maintenance cost, and tenant management strategies. On the other hand, if you aim to flip properties, your focus might be on renovation budgets, market conditions, and resale values. By aligning your plan with your specific objectives, you can maximize your returns and minimize potential pitfalls. If you're ready to take control of your real estate journey and develop a personalized action plan, I recommend that you speak with a realtor you trust. They will be able to provide you with invaluable insights and practical advice specific to your needs. Don't navigate this complex real estate market alone. Take the first step toward achieving your property goals. Thank you for tuning in to today's episode of Real Estate with Nicole. I trust you were able to gain insight into the importance of having a real estate action plan for your U.S. investment journey. If you enjoyed this episode, please subscribe, leave a review, and share it with one friend or family member who might benefit from this information or who's thinking of investing in the U.S. Let me know what topics may be of interest to you. It could be the subject of a future episode of Real Estate with Nicole. This episode is a result of a request from a listener. I appreciate you. Until next time, this is Nicole Lopez signing off. Stay informed, stay proactive, and take care.